Ashwini Agarwal is with us, founder and partner, Demeter Advisors. Ashwini, good to have you with us here. Thanks very much for joining us. For viewers who are watching at what's going on with the currency and with the equity market being slightly sideways and a lot of damage in broader markets, how should they take the rupee depreciation, which is kind of the new dynamic? It was holding above 88.80 2 weeks ago, and now, of course, it's raced away to almost 91.5, 90.5. What's your perspective?
Morning, Prashant. I'm not an FX expert, but I'll give it a shot. So essentially what's going on in my view is the capitulation that typically happens, whenever we've seen a sharp correction in the INR versus the US dollar, whether it was 2013 or, it was, previous bouts of significant devaluation. You see a situation where everybody panics, the importers panic, there's speculation that goes on, and it pushes the rupee to an unsustainably low level, and then it kind of climbs its way back. So this time around, what's happening is that the deal with the US on tariffs, which was expected for several weeks now I think the hopes have faded somewhat. People hope that the deal will happen, but I think the confidence around that has waned a little bit. And I think also the interest rate dynamics are feeding into the exchange rate, in the sense that there is a general expectation that RBI will cut tomorrow by 25 basis points. And even though the US dollar or the US markets are expecting a 25 basis point cut in the US as well, I think the lower interest rate is hurting the rupee outlook. And last but not the least, foreign selling continues unabated. And that, I think, has to do with the fact that Indian growth in earnings has been quite tepid, and foreign investors are probably raising cash from secondary markets to participate in primary markets where the paper flow continues to be high. So there are a lot of kind of intermingled dynamics here. I'm not sure, what RBI wants to see as a stable level before they participate. And I don't know what they feel about the reserve situation and how much they want to spend to defend the rupee. And these are hard calls. I think, I'll just leave it at that. I think for equity market investors, what it really means is that anybody that's long dollars in the revenue stream with no significant costs in other currencies. And I make that as a point because the dollar has been depreciating versus other currencies. So if you're an importer from China exporting to the US, you're squeezed on both sides. You're squeezed on the cost side as well. So some of the net dollar receivers on the revenue side is probably going to have a sentimental tailwind, which is why what we are seeing in IT services right now. So that's about it, I guess.
Okay. All right, that's on the dollar rupee. Hi, Ashwini. Great to have you in. So I wanted to discuss pharma because some interesting developments taking place here last couple of days. Wockhardt, announced further regulatory approvals for its antibiotic drug that could be well over $1 billion. That's what the company feels in global sales, Zynic. And look at Sun Pharma. Sun Pharma Advanced Research is up almost 20% because, again, there's a favorable US court ruling that gets them what is known as this PRV, which is basically an incentive for developing, less attractive drugs. So it's an incentive. You can either use it yourself or you can actually sell it in the market. Something like the TDR that we have here in Mumbai in real estate. So anyway, there's a slight favorable news flow coming in. Biocon is now looking to attract some capital, perhaps. We're in a defensive sort of a mindset in the market as well. So does pharma make the cut for you? And if yes, then what kind of companies?
So great question. I think, what has happened is that some companies in the last 10, 15 years have spent a fair amount of money on novel drug discovery. Sun Pharma, for example, has done a little bit of novel drug discovery via Spark. But they've also done a lot of buy and process type of deals to build up their specialty portfolio in the US. The other name that comes to mind is Glenmark, that has had a significant success in out-licensing a novel drug. And then you spoke about Wockhardt Zynic, where the application has been accepted by the US FDA. I don't think it's an approval, it's an acceptance, and the approval hopefully will follow in due course of time. Now, what this indicates is that the Indian ecosystem in pharma is now getting to a point where companies are willing to put serious money behind drug development and drug invention and drug development, which I think is a very, very positive sign. And you have 3 companies now having demonstrated some success, and that I think is a huge positive in my view. So from the export side, I think I continue to be positive on some of these names where you have a differentiated portfolio or a differentiated go-to-market. And then in the Indian space, again, you have to look at differentiated companies to benefit from this defensive stance. Now, let me explain what I'm saying. In the local market, what I see happening over the next decade is a significant shift towards generic. And to my mind, that is an opportunity as well as a threat, because the kind of premium some of the brands get today may come down significantly, or at least the share of branded pharmaceuticals being sold in the overall pie might shrink. So, I mean, in the Indian landscape or in companies where the domestic revenues are concerned, you will see a shift from the premium on branded generics to more generics, and that's something that you have to bake in. So it's a bit tricky, but you can do it. So there are select opportunities out there in pharma, and as a defensive play, I agree with you that that's a place to hunt.
All right. Hi, Ashwini. Morning. Good to see you in. What are you making of the real estate market? On a health front, a lot of calls with regard to pollution. Oof, what's going on there? Hopefully that settles down. But I think you have been positive on REITs, if I remember correctly. And you had said that that's the better way to play it.
Yes.
Real estate stocks have seen a big correction from the top. Do you still stick to that REITs, or do you think now post this correction, maybe you could look at the core real estate stocks itself?
So, Nigel, great question, because, REITs appear now to me as reasonably valued. They were very undervalued 2 years ago, and they were relatively undervalued even 6-8 months ago. But now they are no longer undervalued. And they're a play on commercial yield more than a real estate itself. So, you're really buying into leased office space and taking those cash streams and viewing it like a hybrid, a growth come yield product. So, for a risk averse investor trying to build income streams, that is a very good alternative with potential for appreciation, because most of these REITs were trading at discount to NAV. Today, that's not the case. But real estate stocks have come off, like you rightly point out, and that makes things interesting. The market has consolidated thanks to RERA and thanks to the stringency that both regulators and investors and banks have brought to lending practices in this space. So most of the big players will be survivors. Having said this, I think the only thing that bothers me is that most of the development is happening in the super premium luxury space. I mean, that's what's dominating the headlines, and I'm kind of a little gobsmacked as to how many people can afford to buy 100 crore homes. I mean, so that kind of leaves me scratching my head as to what's happening to the mainstream real estate market. And typically what we've seen is that in economic slowdown, and if markets don't do well, real estate tends to follow. I'm not sure whether this is the case this time or not, because typically real estate cycles are 7-8 year cycles, and this bull cycle began in 2001, 2002. So we are relatively early in the cycle. But I think I pointed out kind of some of the advantages and disadvantages, and with the price correction, there might be opportunities out there. So that might be a place to hunt as well.
I just want to...
So Surabhi, just to come in, I don't know, the 100 crore homes, I'm very satisfied in the home that I'm currently living in. And going by the rupee, next year's overseas trip as well is cancelled. It has to be domestic.
On affordable homes, Ashwini, I'll tell you this, maybe I'll forward you that report. Since you mentioned you don't know who's buying these houses. Yesterday, one of the real estate consultants came out with a press release and a report. And I saw the title and I think I somersaulted in my chair. This was Collier's saying most tier 1 cities see notable improvement in average affordability levels since 2010. So yeah, I did a somersault in my head. I'm still trying to go through the report and I'll share it with you. And we'll see if it convinces us that indeed housing has become more affordable. But
just off the thing, right? Why 2010? Obviously, it'll be better than 2010, right? You should look at it over the last 4 years, 5 years.
See,
What is Why is 20? I mean,
So
50.
apparently we can afford houses.
So you're basically saying that the average pay is up a little bit compared to 2010?
I couldn't go beyond the
Be true,
title
right?
and the first two lines of the summary. I mean, I just kept staring at it. So I'll tell you when I read the whole report if it makes sense.
I think Ashwini is saying something. Ashwini?
That would be true. Like from 2010 to today, appreciation in real estate is probably much lower than nominal GDP growth rate. So arithmetically, that would be true. Affordability
Oh yeah,
is
that's
better
what.
today. Yeah.
So since we're on the subject, I have the report open. Average affordability measured by the average housing price to income ratio. That ratio has improved from 88.5 to 45.3 in the last 15 years. Ratios are fine. At the end of the day, you go with a check and try and buy an apartment in Delhi or Mumbai. Good luck. I don't know. I have not been successful. So it is what it is. But Ashwini, tell us, I mean, in this sort of a market, I mean, leave us with your overall broad thoughts. Next 6 months, we're entering a new year as well. I mean, do you feel that momentum and that action is going to come back in the broader markets as well? Or do you think we need to just, prepare for more consolidation and then hope for more stock-specific ideas?
So, Survi, I'm going to say something which I hope I won't regret. Okay. I don't think I have been able to find a lot of bottom-up opportunities over the last 12 to 15 months. Okay. But in the last 3 months, I'm starting to find a lot of interesting bottom-up opportunities which give me a reasonable IRR. In terms of an outlook and not baking in excessive optimism either on valuations or on earnings outlook. So I think the correction in the broader market, especially stock-specific real estate names, for example, you pointed out, offers an opportunity from a medium-term perspective. Now, I have no idea what the market will do in the next 3 months or 6 months or possibly even a year. But if one were to buy some of these names and hold them for a 3-year period, I would venture to think that you'll do reasonably well with a mid-teens kind of a return on a conservative basis. Now, I think there are a lot of ifs and buts because I think, the US looks a little, in an iffy place, especially with all the noise coming around AI investments being ill-affordable. I think in India, we have a challenges cut out, assuming that the US trade deal doesn't materialize. So I think we have to navigate these challenges, but I think medium-term outlook is good. So I feel a little more constructive today than I did a year ago, and that's a thought I want to leave you with.
Relatively sort of more constructive in that sense. Thanks very much for joining us, Ashwini. Really appreciate your time here and good speaking with you as always.